Hello viewers, in this video I'm going to explain the concept of factoring used in financial management decisions. Specialist finance companies, usually subsidiaries of banks offering factoring arrangements, provide three main services. One, they provide finance by advancing say 80% of invoice value immediately, the remainder being settled when the client's customer settles the debt, but net of a charge for interest. Two, take responsibility for the operation of the client's sales ledger, including assessment of credit worthiness and dealing with customers for an additional service charge, typically 2% of turnover. 3. They may, for an additional fee, offer non-recourse finance that is guaranteed settlement even if they are not paid by the customer. Let's use an example to understand the concept of factoring. Alpha Incorporated has been set up for the purpose of importing commodities which will be sold to a small number of reliable customers. Sales invoicing is forecast at $300,000 per month. The average credit period for this type of business is 2.5 months. The company is considering factoring its accounts receivable under a full factoring agreement without recourse. Under the agreement, the factor will charge a fee of 2.5% on total invoicing. He will give an advance of 85% of invoiced amounts at an interest rate of 13% per annum. The agreement should enable Alpha Incorporated to avoid spending $95,000 on administration costs. To fully understand the concept of factoring, I will first calculate the annual net cost of factoring, and then I will discuss the financial benefits of such an agreement, assuming that the current interest rate on bank overdraft is 12.5%. Now, when you look at these figures, annual sales comes to $3.6 million. That is $300 per month sales multiplied by 12 months. Now we calculate the annual net cost of factoring. Fee is 2.5% of 3.6 million, that is $90,000, while the annual interest on 85% advance offered by the factor organization can be calculated, and the amount comes to $82,875. If you just look at the figures, it simply shows that we have multiplied 85%, that is the percentage of advance offered by the factor, then 2.5 months divided by total 12 months in a year, multiplied by 3.6 million, that is the total sales or annual turnover, multiplied by 13%, that is interest charged by the factor. So now total annual cost comes to $172,875, and the administration cost that we are going to save, that is $95,000, should be deducted, and the net cost of factoring would come to $77,875. Now the borrowing of $637,500, that is the amount that we obtained for 2.5 months from factor. So this would cost at the rate of 12.5% to $79,687.50. So therefore, factoring offers a saving of around $2,000 as well as providing certain advantages. So how this figure of $2,000 is calculated? We know that the net cost of factoring is $77,875, while the cost of borrowing from the bank is $79,687. So the difference comes to approximately about $2,000. Anyway, so what additional advantages the factor involve would include: one, flexibility. As sales increase with the corresponding demand for finance, so finance from this source increases. 2, security. It allows the firm to pledge other assets as security for the finance. 3, last resort. It may be the most cost-effective lender to a firm which has no assets to offer as security. And finally, responsibility. It relieves management of the responsibility for the sales ledger and can probably perform credit checking better than the firm. I hope you enjoyed this video. I'll regularly upload more educational videos for students of accounting, finance, and general viewers. To stay tuned for future updates, please subscribe to my channel and press the bell icon for notifications. Thank you for watching.